Most people believe modern investing is smarter, that with enough data, tools, and timing, you can beat the system. History seems to support that idea. Markets evolve, technology improves, strategies get more complex. Each generation thinks it's finally cracked the code, but the real story is very different. Because while investors chase new methods, something ancient has been quietly winning. For thousands of years, empires have risen, fortunes have multiplied, and markets have collapsed. Yet one simple rule has outlived them all. It wasn't born on Wall Street. It didn't come from economists or hedge funds. In fact, it existed long before modern finance even had a name. And somehow, it still outperforms the strategies people chase today. That's the contradiction. The most powerful financial principle isn't new. It's ancient, simple, and almost completely ignored. The strange part? Almost everyone has heard it, but almost no one actually follows it. So, why does this rule keep working, even when everything else changes? And what did people thousands of years ago understand that we've forgotten today? Because to answer that, we need to go back to where it all began. Today, investing feels complicated. Screens filled with charts, endless predictions, voices telling you what to buy and when to sell. There's always a new strategy, a new trend, a new once-in-a-lifetime opportunity. So people jump from one idea to the next, trying to outsmart the market, trying to move faster than everyone else. But most end up in the same place, back where they started, or worse, because the more complex it becomes, the harder it is to stay consistent. And that's the hidden problem. Modern investing promises control, but often delivers confusion. Yet long before algorithms, before hedge funds, before financial news even existed, there was a different way, a simpler philosophy, one that didn't rely on timing, didn't depend on predictions, and didn't require you to beat anyone else. It was quiet, steady, almost invisible, but it worked, and it kept working for centuries. To understand it, we have to go back, far before modern finance had a name, to a time when wealth wasn't measured in stocks, but in survival itself. 3,000 years ago, wealth looked very different. It wasn't numbers on a screen. It wasn't stocks, apps, or digital accounts. Wealth lived in physical things. Grain stored for winter, land that could feed generations, gold that could survive war and time. In places like Mesopotamia and ancient Egypt, people face a problem that still exists today. How do you protect what you have and make it grow? There were no financial advisors, no market forecasts, no safety nets, only survival. Farmers depended on seasons they couldn't control. Merchants risked everything on long trade routes. Rulers managed resources that could collapse overnight. One bad decision, and everything could be lost. So, over time, people began to notice patterns. Simple behaviors that worked, mistakes that repeated, outcomes that followed certain choices. These lessons weren't written in books. They were lived, passed from one generation to the next, and slowly something began to emerge. A quiet rule, not built on theory, but on survival. It didn't promise quick wealth. It didn't rely on luck. But it did something far more powerful. It lasted, and it shaped the fortunes of merchants, rulers, and entire civilizations. But what exactly was this rule? And why did it work when so many other approaches failed? Because that's where the real story begins. The problem was never earning wealth. It was keeping it. Even in the ancient world, people could become rich. A successful harvest, a profitable trade journey, a ruler's reward. Money could come quickly, but it rarely stayed. Because just as fast as wealth appeared, it disappeared. Bad decisions, risky bets, careless spending, or simple neglect. A merchant might risk everything on one shipment. A landowner might overextend during a good season. A ruler might spend without thinking about tomorrow. And when things went wrong, they didn't just lose profits. They lost everything. And here's the uncomfortable truth. Human behavior hasn't really changed. The tools are different. The systems are more advanced. But the emotions are the same. Greed pushes people to chase more. Fear causes them to panic and sell. Impatience makes them abandon long-term thinking. The cycle repeats. Gain, lose, Start again, over and over, because without a system, discipline breaks. And without discipline, wealth doesn't last. Even the richest individuals of the ancient world face this pattern, rising fast, falling just as quickly. So the real question wasn't how to make money. It was how to stop losing it. And that's where everything begins to change. Because once that question is asked, a different kind of thinking starts to form. Then came a realization. Simple, but powerful. Wealth doesn't grow from what you earn. It grows from what you keep. That idea changed everything. Because for the first time, the focus shifted away from chasing opportunity and toward controlling behavior. It wasn't about making more. It was about managing what already existed. And that's where the real breakthrough happened. Instead of spending first and saving what was left, people began to reverse the process. Divide first, decide first, control first. Every piece of income had a role, a purpose, a place it belonged. Some for living, some for protection, some for growth. Not random, not emotional, but intentional. And suddenly, chaos turned into structure. Because when money is divided before it's spent, impulse loses its power. Greed becomes limited. Fear becomes controlled. And patience finally has space to work. It wasn't a complex system. No formulas. No predictions. Just a rule. Clear. Repeatable. Almost too obvious to matter. And that's why most people ignored it. But those who followed it started to see something different. Their wealth didn't just appear. It stayed. And over time, it grew. Because this wasn't just a habit. It was a mechanism. And once it was understood, it began to spread. Ancient merchants began to notice something strange. Not dramatic. Not sudden. But consistent. While others moved between wealth and loss, their fortunes grew slowly, quietly, almost unnoticed. They weren't more intelligent. They didn't have better opportunities. And they weren't protected from risk. They faced the same markets, the same uncertainty, the same dangers. But their outcomes were different because they followed the rule. They divided first. They controlled their resources. They stayed consistent, even when it felt unnecessary. And that consistency created something rare, stability. While others reacted, they remained steady. While others chased, they held their structure. And over time, that difference began to compound. Small gains stayed. Losses became manageable. Recovery became faster. Years passed, and something deeper started to form. Their wealth wasn't just growing, it was stabilizing. And stability changes everything. Because when your foundation is strong, you can take better risks, make better decisions, think beyond survival. That's when wealth turns into influence. Influence turns into power, and power into long-term prosperity. Not because of luck, but because of control. And once others began to notice this pattern, the idea didn't stay hidden for long. As trade began to expand, so did the idea. Routes stretched across regions. Goods moved between distant lands. And with them, knowledge traveled too. Merchants didn't just exchange products. They exchanged methods, habits, ways of thinking. And this simple rule started to evolve. Different cultures shaped it in different ways. Some turned it into tithes, a fixed portion, set aside before anything else. Others built savings rules, strict divisions that control how wealth was used. And some went even further, using surplus not just to preserve wealth, but to grow it. Early forms of investment began to appear. The details changed. The structure adapted. But the core idea never moved. Control allocation before impulse takes over. That was the constant. Because no matter the system, the danger was always the same. Uncontrolled spending, emotional decisions, short-term thinking. So this rule became something bigger. Not just a tactic, but a philosophy, a way of managing wealth that didn't depend on markets or timing or luck. It became embedded in daily life, in habits, in traditions, in expectations passed from one generation to the next. And over time, it stopped feeling like a strategy. It became normal. But as history moved forward, something began to change. Because the more advanced systems became, The easier it was to forget the simplicity that made them work. Today, the financial world looks completely different. Markets move in seconds. Information never stops. Opportunities appear everywhere, from stocks to crypto to endless new strategies promising faster results. But underneath all that change, human behavior hasn't moved at all. People still chase quick gains. They still believe they can time the market. They still abandon consistency for excitement. And the result? The same pattern from thousands of years ago. Gain, lose, start again. Only now it happens faster. That's the irony. Many modern strategies are actually trying to solve this problem. They talk about diversification, risk management, long-term discipline. But these ideas aren't new. They are echoes of something ancient. The difference is complexity, layers of data, tools, predictions. And while those tools can help, they often do something else. They distract, because the more complicated it becomes, the easier it is to forget the core principle. Control what you do with your money, not just where you put it, because in the end, the system hasn't changed. Only the noise around it has. And when you remove that noise, you start to see something familiar, something simple, something that was always there. The real power of this rule isn't financial. It's psychological, because at its core, it changes how you think. Most people react to money. They earn and decide. They spend and adjust. Every choice becomes a new decision, and every decision drains energy. That's decision fatigue. Over time, it leads to mistakes, emotional choices, inconsistent behavior. But this rule removes that problem, because the decision is already made. Before the money arrives, it already has a purpose. And that does something powerful. It reduces noise. It limits emotion. It creates automatic discipline. You're no longer reacting in the moment. You're following a structure. And structure creates stability. Fear has less influence. Greed has less control. Impulse loses its power. Because the system is stronger than the feeling. That's the shift. From reactive to intentional. From chaotic to controlled. And once that shift happens, everything changes. Because wealth isn't just about numbers. It's about behavior. And when behavior becomes structured, results become predictable. That's where real wealth begins. Not in the market, but in the mind. Across centuries, everything has changed. Technologies evolved. Markets transformed. Strategies appeared and disappeared. Each era believed it had found something better, something faster, something smarter. But beneath all of it, one principle never moved. Not because it was new, but because it worked. Quietly, consistently, without needing attention. It never promised fast wealth. No shortcuts. No overnight success. Only something far more rare. Consistency. And that's what most people overlook. Because consistency feels slow. It feels boring. It feels like nothing is happening. But that's the illusion. Because while others chase speed, consistency compounds. While others react, consistency builds. And over time, it wins. Not loudly, not instantly, but inevitably. That's the difference. The world rewards excitement, but wealth rewards discipline. And this ancient rule understood that long before modern finance existed. So the question isn't whether the rule still works. It always has. The real question is, will you follow it when everything around you tells you not to? Section 11, CTA. So the next time you think about investing, pause. Ask yourself one simple question. Are you chasing complexity or following something timeless? Because the smartest strategy isn't always the newest. It isn't always the fastest. And it definitely isn't the loudest. Sometimes it's the one that's been quietly working all along, for thousands of years, ignored, underestimated, but never broken. So before you look for the next big opportunity, make sure you haven't overlooked the one that already works. Because this rule isn't hidden. It's been waiting for you to finally take it seriously.